Failure Guy. Welcome to the podcast. Joining us once again on this episode of the Failure Guy podcast is our guest, Glenn Jones. Glenn, welcome back, and thank you for joining the conversation.
Hey, Cornell, I'm glad to be here again.
Okay. Well, thanks again for joining us, Glenn. And as those of who are listening out in podcast land will remember, last week we had a very exciting and engaging conversation, but we were just getting started when we hit the hour mark, and you were just starting to get into a lot of the really sound financial advice and sage wisdom that you shared with me offline. I really know that the listeners in the Failure Guy podcast audience will benefit from. So let's just pick up right where we started from last week.
Okay.
So I believe we were discussing, well, actually, what I would like to discuss, regardless of what we were discussing, is the different types of insurance investments. And actually, I was talking to some young gentlemen who are colleagues of mine. I just closed actually a very good contract that I'll be doing, working with a trade union-based organization, and these gentlemen are on the board. And I was asking them, because they're still working, they're union members, one works for the Department of Education, one works for the Teachers Union, and I was asking them if they had life insurance. And one of the gentlemen says, oh yeah, I've had a policy for years. I said, what kind? And he says, term life insurance. I said, I heard that was the best, and that whole life insurance is a scam. I was like, nah, brother, you got it exactly backwards. But it's also important what type of whole life insurance. But, you know, to get term and invest the rest, completely the wrong thing goes. These are both young gentlemen in I believe in their 20s or early 30s. So please share with them, because I'm going to give them the link of this episode as soon as it goes live, and to everyone out there in general, particularly those people who are at the beginning of their professional careers, what you shared with me about the different types of life insurance and the best way to invest.
Well, let me start off by saying life insurance is not an investment. It acts, the whole life policy acts like an investment, but it is not an investment product. So for those who are seeking to do life insurance as an investment, it is not. I would say a better understanding of a whole life policy is it's a savings account, an aggressive savings account that has a death benefit. That is the perfect way of looking at it. By law, life insurance should not and cannot and is not an investment product. It just acts that way, but in reality, it is a glorified, progressive, performing savings account that has a death benefit. The interesting thing is that with that perspective in mind, most people have been encouraged, as we talked about last time, to buy a term life insurance that's inexpensive, but it is an expense cost to you, which makes it a liability to you, because in the end, once the expense is matured, then you have no cash accumulation, you outlive the death benefit, and it goes away, and it's been a waste. When in truth, you knew from the beginning there was the companies knew from the beginning that there was probably 98% chance that you would outlive that policy. So from the beginning, who's in the market of throwing away money? Not as an investment, that makes no good sense, right?
Right.
Then the next thing, we're told to invest the rest. So now we're immediately thrust into putting money in market where the market gives a return. And the static, as we stated last time, the static statement is that over 10 years, you would average a 10 to 12% return. But they never define that rate of return is a gross return, not a net. So in the net return of invest in the market, typically the average is maybe 3 to 4% or 5%. Most people didn't understand that, but you share all the risk of loss. And you can lose every dime while in the market while paying fees on top of that. So imagine you losing $50,000, but you also lost $60,000 because you had fees that you had not accounted for. And we're not saying that being in the market is a wrong thing. It's just maybe you may have the cart before the horse,
Right.
where you need a principal protection and guarantee before you're in the market risking all. And
Okay.
that's illogical.
Now,
You got to go
I'd like to
ahead.
jump in right here because we discussed this offline. I'd like you to clarify for our audience two things. First of all, the difference between the gross earnings in this so-called investment, if you're tracking it on the market, and who, like you say, the investor, the policyholder takes all the risks. Who doesn't take the risks, and where does that balance between the gross and the net earnings go?
Well, again, that's a good point. The fees are paid to a broker. So part of that goes to them, and the taxes goes to the government.
Right.
So then taxes goes to the government, and where the fees go to the broker, and the taxes goes to the government.
Right.
At your expense.
Right.
It's not even the employer isn't even paying those. The employer gives you a bonus in that 401k retirement, but you pay the taxes and the fees on that bonus. However, should the market lose all that you have in accumulation, you share the total loss on all that was in that account at all time. That's 100%. And the question you should be asking yourself, if you have $500,000, how much can you afford to lose? Can you afford to lose all of it? Half of it? Well, only the portion you can afford to lose should be in a market product.
Okay.
You should not afford to sacrifice your permanent on the altars of the temporary, putting all that.
Okay. Please say that again for those who weren't listening.
You should not sacrifice the permanent on the altars of the temporary by putting all at risk.
Wow. Wow. And would I be correct in assuming that whether the market goes up or down, that those brokers are still going to collect their fee, whichever way the market goes?
In an up and down market, it doesn't matter. Fees come out. You remember we talked about this.
Yeah.
The AME Church had a 401k that in 2022 lost 100 million out of 120 million.
Right.
In the South Florida retirement fund for their pastors. Well, actually, up front, their original loss was 96 million. But after they calculated the fees, it was 100 million.
Wow. So you're telling me those brokers collected $4 million?
Yeah, and this is over a spread of time period that the money's. Yeah, they did. And where we talked about, is it best that you pay a commission or pay fees? And we agreed.
Yeah.
It's better to pay a commission if you were paying in the same case scenario $10,000 in commission.
Right.
That's a single payment. That's done. But if you're going to end up paying for the same case $75,000 in fee, which is best for you.
Okay.
So you've been educated and trained to feel that you would get the best option. And some of the static statements while things are in the market and the market's going up and down like Charlie Brown is don't act out of fear. Well, for some people who still like Buffett has 100 million that will never be lost because it is never in the market.
Right.
He has that and only his gains are in the market. He doesn't have to fear. You can stand solid on that static statement that comes out every time the market is crashing. The counsel to everyone is don't act in fear. The market will correct itself.
Right, right.
But problem is that the many people, extremely in the African American community, are all in the market.
Right.
No principal protection, so they should fear.
Right.
If they law, and they said, I heard this conservative person just saying, well, it's all lost on paper. As long as you don't pull it out the market, it's still just on paper. Well, the thing is that it may be on paper, but if you also had taken a loan, there's going to be a call that you got to that loan all full and immediately.
Yes.
So
Yes.
those are some of the traps that may be disadvantageous to you if you're not well acute to the nuances of being in the market. There's nothing wrong with it,
Right.
but you want to be in there in a holistic, in a scientific, in a stable manner that you're not sacrificing the permanent, all that you have on the altars of the temporary, the
Right.
hopes of the gain, and you're sharing all the risks, not the broker, not the
Exactly.
government, just you and not your employer.
Mm.
So at the end of the day, when you retire at report, you remember Enron,
Oh
don't you,
my
Cornell?
gosh. Oh yeah. I'm certainly old enough to remember then.
We can't have a short memory that they took their retirement money. It's
Right.
gone.
Right.
Did they ever get it back? There was no
Probably not.
report that they recovered it.
Right.
So if you cannot afford to risk losing it all before you're in the market, you need security and you need guarantee that gives you POM for your IRA. Peace of mind for
Okay.
issues requiring attention. Hello,
Oh,
breaker,
okay.
breaker.
Okay. Yes, indeed. And yes, because we talked about offline about Enron and how, in a lot of ways, that was the beginning of the leveraged buyout fiascos, where companies sort of swooped in with unvested in annuities, and then sacked these businesses and laid the people off so that they could take all of that money. And now you said something during our offline conversations I'd like you to share with the audience when you said that Warren Buffett made a statement that he never lost anything and he was never anything at risk. And I'm thinking, wait a minute, he invests in the market and the market goes up and down. But then you clarified what he was talking about. I'd like you to share that with the listening audience.
Well, I'm glad you brought that up. Warren Buffett's statement is his number one rule is to never lose money. And his number two rule is to remember rule number one,
Yes,
never lose
indeed.
money. And so I don't know, some people may be familiar with another lady in the market explaining investments, Susan Orman.
Yes.
And she was called to the carpet, say, Susan, you teach everyone that, yes, you're going to get the static 10 to 12% return over 10 years of being in the market. So invest in the market for your best return. But Susan, you have 41 million and you have none of it in the market. How are you
Oh,
telling and coaching people to put their money in the market for the highest rate of return of 10 to 12%, and you have none of your 41 million in the market? Her answer was, I cannot afford to lose the quality of life I'm used to.
mm,
I do not put my principal in the market. I put his gains in the market. So what Buffett does is said, hey, I have 100 million or 100 billion in the market. I mean, not in the market, but that 100 billion is already generating maybe 3, 4, 5%, and I'm getting a million a month. Okay.
mm.
I take that million a month in gains and buy other companies in other markets. So should that take it all and lose it, go south, I still got my 1 billion. So I
Right.
never risked my principal that I originally had. So I never will be broke another day in my life because I'm never going to risk my principal.
Right. So basically,
So
he's got his principal
protect.
earning interest, and all he invests is the interest from the principal, but never the principal itself.
Right. And I think that that would be uh, necessary to convey that to people before they're convincing them to put all their money in the market for a gross return, and no one figures the net return after taxes and fees are taken out, that they only get 3 or 4 or 5%. When in many cases, when you're talking to these young um, people who are working, that they could have done a PPWL, a participate in permanent whole life, that is a savings account that has a death benefit, that they were going to avoid the taxes, they were going to avoid the risk of loss, and they would have access without penalty, and they would have an increasing and compounding death benefit as their principal increase and compound. That would be smarter for them. And then later, the gains that the dividends paid in a PPWL policy, they can put that in the market like Buffett and never risk the principal accumulation that they have in their policy.
Okay, so let's talk about that. Here we get to the meat of the meal. The PPWL, is
Yeah.
that?
Yes.
Yeah. So as I said yesterday, I was talking to two young gentlemen in their 20s and 30s, both very well employed, working for unions, working for the city and state of New York. And one of them said, "Oh, I've got a term life insurance policy," which clearly, as we've discussed, that's just not the way to go. He's young enough to turn around and correct it. So that PPWL, how does that work so that people, obviously not at the same scale of a Warren Buffett or a Susie Orman, but how can they find themselves in a similar situation where they can grow their principal and have, interest from that to invest without ever risking? And as you said, and I love the way you said, I'm going to put that in my list of phrases, never sacrifice your permanent on the altars of the temporary. So please go into how that works.
So the sweet spot about the principle, the company is a mutual company that says it's participating. Participating means above the interest, guaranteed interest the policy makes, they share a return or premium and dividends of profit of the insurance company as a debt, as added cash accumulative value placed on top of the principal. So at some points, the dividends can exceed going in there what you're putting in there in terms of monthly premium. So that adds more cash accumulative value. Well, the good thing about that, let's say down the road you ended up 10 years into your policy after putting in significant premiums in there, you have $100,000 and you decide to go buy yourself a car. Well, in the past, you would go buy a car through a bank on what they call it compounded interest daily loans,
Right.
which means in the end, you're going to pay, you borrow 40, you're going to pay probably 65,000 for a $40,000 car.
Right. Which devalues as soon as you drive it off the lot.
The values, and by the time in 5 years you paid off that car for 65 that you bought for 40, it's only worth 5 or 10 or even less.
Right.
It's stupid on steroids and ignorance going to see, right? Ignorance going to see because we didn't know better, we didn't do better, and we've been trained to buy term and invest the rest, but we've been trained to get a compounded daily interest loan. We're in the whole life policy. Remember I said,
yes,
it is a savings account that has a death benefit. Forget about the death benefit. Let's look at the savings component. Well, in the PPWL policy, earn the interest and dividends. You borrow against the cash accumulation, then that's tax free. There's no penalty. You can do it at any time, whether you're 59 and a half or not, and you have an option to pay it back if you do a withdrawal. Withdrawal means taking money out of account, no penalties. And since you first in, it's a FIFO situation where you pay your tax money, tax premiums in there. Then the first money coming out, FIFO, is can't be taxed because it's already been taxed. So you can do a withdrawal to take that out, and you don't have to put it back into the policy. No penalty, no problem. But the encouragement is that rather than do a compounded daily loan through a bank, do a simple interest loan through your policy. Now, simple interest and compounded daily, that's a conversation you need to have with your banker,
right,
because they don't tell you about a simple interest loan.
Of course they don't. It's not in their interest.
They drop you in the compounded daily because why am I going to give you a simple interest loan where you may have paid 45,000 or 48,000 rather than 65,000 for the $40,000 car when I can get you to pay 65,000
exactly
on borrow for that car. So I'm not going to introduce you to the simple interest loan. Hello,
right.
breaker.
Right. Their job is not to save you money. Their job is to make them money.
Is to make them money. So, and both loans were available. That's like different between a 30-year fixed loan, 30-year fixed mortgage compounded daily, a HELOC, and a first lien HELOC. But that's another conversation.
Yes.
Another day. So in the PPWL, it's a simple interest loan that while you're paying it back, you're paying yourself back because you took the loan and paid cash for your car. So you paid $40,000 for the car, and since you paid $40,000, had $40,000 in cash, you actually bought the car for $36,000. They gave you for paying cash up front.
Right.
Which I reference biblical context that says you shall be the lender and not the borrower. So in this mannerism of this applied principle and precept, You are now the lender and not the borrower, because now you've taken money out of your policy as a loan from yourself to yourself, paid cash for the car, got it at a discounted rate because you paid cash. Now it is a rolling asset and not a rolling liability. Hello, breaker, breaker, which means in turn, you can go back and take a loan against the car.
Wow, because you own it outright.
You own it outright. And that's the smartest way to do it. The wealthy do it. I don't think they ever need to take a loan against their car. But if you had to,
Well, if they're
you had
driving
an economic,
Maseratis or Lamborghinis or something.
right, if you had an economic shot, like they're talking about Floyd Mayweather, that he might be broke or going broke, he could go back and take equity out of those cars and watches that he owns. Okay. And things of that nature. So with the PPWL, the sweet spot, I think this is awesome on steroids. While paying back yourself, you're earning interest and dividends while paying a simple interest of 5%. Well, if you did not make a payment, no one's going to call you. No one's going to bother you.
Right.
Well,
Because who's the lender? Oh, that would be you.
You are. Hello, breaker. And you may choose to pay interest only on that loan that year. Interest only. Just pay the insurance company interest only. Or you may stretch it out to a 10-year or a 20-year. It's your discretion how quickly and soon you pay yourself back.
Right.
Where do you have those terms in anything else that you borrow from?
Well,
and the answer is nowhere.
Right. And how many people even know that these sorts of options are even available to them? And honestly, I'll be honest with you, and I know people who are in the insurance and banking industry, and our conversation is the first that I ever even heard of these options.
Exactly. So we're uninformed, uneducated, and we perish for the lack of knowledge. Our opportunity at Insure Financial Group is to convey education and understanding so you can make a healthy, holistic, and scientific decision for your future and in their future days. You know, at some point, life can throw curves that even if you got hurt, sick, or injured, and you needed access to capital, where in the bank, since you're unemployed right now, imagine this, Cornell, you have a daughter or a son, let's say a daughter, both are precious sons and daughters, and daughters, and they just got terminated for their job. They bought the house, they bought the car, and they were single, bought all the house and the car, but now they're terminated from their job. Are they likely to call you and say, assist me in paying my house, that it may take me 3, 6 months, or a year to replace that level of income and job? And if you are not able to help them and they're not able to help them, they're sacrificing the permanent on the temporary. They will get a job again.
Right, right.
But we don't know how soon they're going to get that level of income again.
Yes, and
but
2 car payments, they're gonna repossess that car.
2 car payments, 2 house payments, and they've lost both.
Yeah.
So what if they had heard this conversation, did the PPWL, and had $50,000 sitting in their whole life policy that they can tap and pay their house payment and their car payment the next 3 to 6 months or a year to 2 years until they found and replaced that job? They wouldn't have to sacrifice their permanent home and car on the office of a temporary of unemployment. I hope this is making a little bit of sense.
Well, this is making so much sense. This is why I wanted to have this follow-up conversation immediately after our conversation last week. And more importantly, in the times that we find ourselves in, the economic times, we're probably in one of the most fluctuating and uncertain economic times we find ourselves in. And for those young people out there who are fortunate enough to have good paying jobs that have whatever benefits, you know, first of all, bless all of y'all. But as we're discussing, you got to look in your future. And let's just cut to the chase. Especially here in the Black community, there is almost this superstition against talking about death. I mentioned many times in the podcast here, I lost my mother in February of 2021. And myself and my siblings, we were totally unprepared for this. You know, there was, you know, no burial insurance policy. You know, we actually had to go into debt to put her into the ground. And so many Black families not only do they not have anything that they've accumulated, any wealth to pass on to future generations, all they leave the generations be after them with is the bill for the burial. And this is very important for young people who are in the prime of their lives and the prime of their earning, rather than act as if they're going to be invulnerable and immortal, because nobody is. Plan and prepare for the present and the future. And I like the way that you put it as an aggressive savings account with death benefits, rather than calling it either a life or a death policy, because then people, oh, I don't want to talk about that. I don't want to think about it, as if like the Candyman or Beetlejuice, if you say it 3 times, you're going to make it happen, which is, of course, ridiculous. If you think about it, then you're prepared, because they say that one person came back. I wasn't there at the time, but I don't know anybody else that has passed on and returned. And so we've got to prepare.
I would like to drop a gem on you.
Okay,
I want
please
to
do.
drop a gem on you.
Please do.
Here is I'm a person, principle, and precept about it. Our assignment is to expose hidden works of darkness. Now, look at our community in reality check. You talk to a funeral director, and I work with the funeral director doing what we call prearrangement, burial whole life. Well, they pay for a policy for burial. They only pay 10 years. But I asked them in the state of North Carolina, in the state of Florida, how many families have come to you with 100,000 plus policy in over 10 years? In both states, they said 1. Okay, why? Why is that? Remember, last time we talked, I talked about in the Bible, and this is not, it's just principles and precepts.
Yes.
It's not to persuade somebody. I'm a believer, but I'm not trying to sway you. That's your choice. But I talked about this static statement that I grew up learning. I went to dentist's office and I saw this little book with this character on there we call Jesus. And in there was the first chapter, or the first little story in the book was Adam and Eve eating a red apple. Okay. And because that was the fall of man. And I asked a lady a few years ago, or a gentleman who was filled with all this stuff, what fruit did Adam and Eve eat that caused the fall, according to this story? And they both said an apple. And what color was it? Red. It was red. It was a red apple. So that's a static educational thing that's been out there in the Christendom world of teaching. Well, when you pick up the Bible, you actually read it. It says it was the knowledge of good, was not a fruit. And many times in scripture, it's not talking about a physical food. It's talking about knowledge, wisdom, and understanding when it comes to eating anything. But that's another story.
Consuming, so to speak. Yeah.
Consuming, right. And so getting knowledge and understanding from the divine one is consumption to him for you to grow. So here's what my point is that we statically heard by term and invest the rest. Well, here's the trap. Timeline trap is what I wanted to expose to you. Timeline trap, okay? By your ignorance. If you don't know that while you're young and healthy, that you could have started the whole life, and I convinced you to get the term, I'm literally taking money from you. Had you put it in the whole life while you're young and healthy, you would have been accumulating money. So so there's 2 ways I'm gonna help you miss this timeline and get trapped out of it. Okay, I'm gonna tell you to buy term and invest the rest, and I'm gonna offer you on your job group term. I'm gonna make it even cheaper than term outside of the job. So now you say, as I was working for the corporation U-Haul as an area field manager, I had group term of $300,000, and it was only costing me $16 a month to cover my wife and my children. I'm like, that's a deal. If I transition, yes. And I encourage you, if you have group term on your job, keep it. Yes, it's inexpensive. However, the problem is most people are mistaken that when they get to age 65, that's all they ever had, and that's going to end. They nickel and dime you on that. All that money you put in there added up and now it's gone, and now you can't even afford to keep that coverage when you lose the job. That's great, because what I did not really want in this industry, I feel that they don't really want, is your community, our
Right.
community, anyone to actually transition and get $100,000 to $300,000. We
Right.
knew you had a stronger chance in terms of betting and gambling.
Right.
You had a 98% chance that you were going to outlive the job. I
Right.
mean, you're going to outlive your
The
employment.
policy. Yeah. Right. Right.
It meant you would outlive the term and you couldn't keep it. But now, when you're on the back end and you missed that window when you could have locked in a asset, which was a PPWL, a policy that accumulated wealth with interest and dividends and a death benefit accumulated, you're now older and your health has changed and you don't qualify. Just spoke to a young lady and a man, not young, they're right at the threshold of retirement,
Hmm.
and he has some type of sarcoidosis,
Hmm.
disease of the liver.
Right. Right.
He has no other coverage. And then when we start talking about getting the PPWL, I say, well, given your condition, I got to check with the company to see will they even write you. And the company say, no, you're not
Right.
insurable now.
Right.
You've missed the window. And then she had a couple of the conditions, but they would insure her. So I'm like, we can, if you want to accumulate this money and stick it in there, we got to do it all on her, but we can't do it on you.
Right.
Well, if in mortality tables concerning life insurance, men are more likely to transition before women.
Right.
So the mortality is, if I can help your group of men transition, then and they never have that covered, then that's going to destroy your families. And when you
Right.
think about all the things, shout out to God bless every wonderful sheriff, deputy, policeman, every what you call it, Florida Highway Patrolman that does their job earnestly, but there has been a history of those that have done it wickedly, right?
Yes. Yes. Just
Well,
facts.
when those cases and all the videos I ever seen seem to kind of land in the African American community, that when Floyd, what's his name, Floyd,
George
George,
Floyd. Yeah.
these people who they're hitting, when their bad cops seem to get them, they all seem to not have any life insurance.
Right. Right.
Isn't that interesting? Now you imagine, and this guy said it on the BMM, Black Executive Men meeting.
Yes.
He was telling us that, look, if black men had $100,000 to $200,000 to $300,000 in guaranteed whole life insurance on them, it would eradicate that issue.
Right.
It would eradicate it. But that's not happening because you're educated
Right.
to buy term and get the rest. To get it, do not get whole life. You're told the people who went along, and this I heard this guy teaching. He gave me this tape of guy from A.L. Williams back on Hughes.
Oh yes. My goodness. They've been around forever. Yeah.
They was telling me in my office, hate whole life. Don't do whole life. Why you got giving me to hate something that's accumulating cash for me
Right.
and never gonna go away? And because you can get term in the market. Look, I'm not talking about investment when I'm talking about whole life.
Right. Right.
I'm talking about a savings accumulation, and you done stuck it in the investment and telling me it's stupid on steroid. No, that's a lie from the pits of hell for you to tell me it's an investment. It is not, and it doesn't have to play. It's not. You're talking apples and oranges, Ninja.
Exactly.
You're talking apples and oranges. This is an orange. It produces what oranges are supposed to produce, and it is safe. It is secure from all alarm. Not like that IUL. Now, we talked about the distinctiveness, IUL as opposed to a PPWL,
Okay.
right?
And for the audience, IUL breaks down to
Index Universal Life Policy, or UL, Universal Life Policy,
okay.
or VUL, Variable Universal Life Policy, or an ISWL, an interest sensitive whole life policy, which still is a UL,
Okay.
which all have in common cost of insurance and administration fees and surrender charges.
Surrender charges. Say a little bit about that.
Surrender charges, meaning when you get that policy, the first 10 or 15 years, the cash that accumulates in it, if you turn around and say, I want to take my money and run what is accumulated in this policy, you have a 10-year surrender period, then you have no access to any of that cash accumulation.
Hmm.
And so in a PPWL, if you surrender and say, I want my cash, you take your cash and you run. But in an IUL, you have to wait past those 10 or 15 years.
Okay. So it sounds to me like there are a lot of policies that are being foisted upon communities in general, but our community kind of focusedly, and especially on a lot of young people, which come with more back end fees and penalties, as you're just describing, but also, as we discussed in our private conversation before the podcast, it's almost as if they, because let's face it, insurance companies have the best statisticians in the world and actuarial tables. They can predict practically to the month that most people are going to die if they know enough about you. So it's almost as if they are betting in these term life insurances that you are going to outlive the life of the term.
Right. If you outlive them and I have a 98% chance you're going to outlive it, then all the revenue you give me, I'm never going to pay out the death benefit.
Right.
But when you guarantee and lock in early at a whole life policy, and even if you stop making payments down the road, it could be a paid up permanent whole life. There always will be a death benefit paid greater than the cash that's accumulated. You remember I showed you this example
Yes. Yes.
offline
Yes, I
where
did.
I invest into my grandchild's policy, like mine and my family, since our eyes have been opened, the scales have been removed. Hallelujah, breaker, breaker, come on. That I invest $300 a month in my grandchild's policy. I own it. It's my savings account, extended savings account that has a death benefit on my grandchild. Just making it simple so you can comprehend. So in 15 years, this grandchild, my son, first one just been born last year, he's a year old. Um, he he will have $72,000 accumulated in those 15 years. I
Mm.
no longer would make any more contribution. So how many grandparents have left $72,000 for their grandchild? Not many, because what they did do was sacrifice the permanent on the office of the temporary. They bought them toys, trinkets, thingamabobs,
Right. Right.
holidays and stuff. They were pimpalized by the market, right?
Right. Right. Which they're going to
So,
outgrow and outlast and lose interest in.
and there's no value to it whatsoever. So I told my daughter, listen, I'm going to set up their inheritance according to scripture,
Mm.
inheritance to my grandchild. So I'm not going to participate in the holidays and the toys and the thingamabobs, whatchamacallits. This is my investment in him. So when he gets 18, he can use it towards college.
Yeah.
He can buy his first car and pay cash for it.
Mm.
Or if he doesn't choose to go to college, he can use it to buy his first property and create a revenue
There you go.
producing asset, an
There you
IPA,
go.
an income producing asset. So I'm going to train him up in the way that he should go to create an
Yes.
IPA, an income producing asset, borrow from yourself and pay yourself back and produce an asset to earn what we talked about, earn passive and residual income that you don't have to survive off of just earn income as you've been educated to do. We're still educated to survive off of
Yes.
just earn income, not
Yes.
passive and residual.
Yes. And it's interesting that you constantly return to two themes, which are how we are trained and educated as we grow up, and on biblical principles, not biblical phrases. And I like the fact, and just for the audience out there to be clear, you're not proselytizing, you're not evangelizing. You're saying, look, these are thousands of year old principles that are sound. That's why, like I have a saying, that's how old sayings get old. And the people in the listening audience know that my mother was an ordained evangelist minister. I am an agnostic. But there is one phrase that comes to mind as I hear you speaking. I believe it is from Proverbs. It says, train up a child in the way that is right, and when he is old, he shall not stray from it. And I'm hearing the way that you're investing in your grandchild, and I know that you're going to share these principles with them as he grows older, so that by the time he gets to the age of independent thinking, he will have had solid, sound principles laid into him. And as I've shared, I worked for 7 years back in the early aughts with an organization called Operation Hope. That's how I ended up going to France in 2016, September 2016, because of my work with them. And the founder of that, John Hope Bryant, wrote a book called The Memo. in which he said this, particularly for the black community, the real distinction is not civil rights, it's silver rights, because we live in a capitalist society and it's all about the money. And he says that the game in America is money. And the problem with black America is that we didn't get the memo. You know, when wealthy people sit around the table, they're discussing money, how they make it, how they save it, how they utilize it, how they grow it. And we know it's almost, it is a faux pas. You don't talk about money. You don't ask someone how much they make. Growing up, you don't ask your parents how much money is in the family budget. How much do things cost? You know, why can't I get that toy or this thing or whatever? And so we are indoctrinated that money and earnings and income are things that we're not supposed to talk about. We're supposed to be embarrassed and ashamed of even addressing these concepts and principles. And I like the fact. Please do.
Let me share this with you. I do conferences, I speak, and some conferences I just was a part of. And there's a scripture, which is another principle or thought when you look at it. God says, beloved, I wish above all things, that you may prosper and be in health, even as your soul prospers. So he's saying that which means at the same time, you're prospering in your salvation and growth and knowledge and maturity of who I am. I want you to prosper financially. I want you to increase and multiply in the covenant blessing of Abraham in financial prosperity as well as health, so that you have a long life and you have a salvational life as well. So at the same time. So the reason why I bring that up, because the challenge was getting to do that presentation with that religious group.
Yes.
That they were like very limited in the time they want to allow me to convey. You're giving me an hour here. Yeah. They're starting to say, tell me about the money part in 10 minutes or 15 minutes. And I'm like, Ninja, you every Sunday, Wednesday, you talk about salvation and tithes and offering all the time.
Yes.
But you don't want to talk about how you can fatten the sheep and strengthen the sheep to have wealth, and you only want to give it to 10 minutes. Look, it took me the past 20 years to learn to be able to articulate what I'm conveying to you in the simple terms in this short 1 hour, and you want it in 10 minutes.
Yes.
You're not really being real about the financial salvation, and you won't even open the door to someone can help you unravel and help them create the wealth.
Right.
So that if your sheep in your ministry, which they're not yours, they're the Lord's, but if they had more money, they can give more money, but they can't keep giving more money if they got one income.
Right.
They give more when they give more money off of 3 passive ways of their making money. That's better than them giving all the time off of one, and the whole body is simply and they're straining. And the thing about it is that the baby boomers are the ones that are still in most of those institutions are the ones that's still giving. The generation X and Y or whatever, they're not even going back to those institutions to get locked in the way the baby boomers did. And so they're struggling. And I'm like, but you won't allow financial literacy and education to come in there? And God said to you, above all things, I want you to prosper.
Right. Imagine if young people would go to whatever, their church, their temple, their mosque, or whatever have you, and they were taught principles from their faith that showed them how to prosper. See, there's almost this religious anathema, to use a religious term, against even considering material wealth, material growth, material gain, as if it is counter to being a person of faith to also be a person of wealth, which is you're sharing. Go ahead.
All because it just gets deeper and you get out there and it's like the static thing with the apple. There is a religious group that is trained to say, look, this is the paradigm we're going to teach them based on this book. Now, when you read it and you study, you find out, wait a minute, Ninja.
It didn't say that.
That ain't how it went. That ain't what it means. I've been taught to read, but I've been taught to read with comprehension. When I read it with comprehension, what you have taught me religiously is a lie.
Right.
You haven't taught me the truth. And so I can't reconcile with that. It's not making a difference to me. And I'm ending up broke, busted, and disgusted. But if I read this here and study it, it reveals that no, here is the way. And yes, I'm about your financial success. Success financially started with the creator and ends with the creator, and there is no other way.
Right. And as I
And you
like to
have
say to people, go ahead. As I like to say to people, there's no such thing as a broke philanthropist.
no,
So as you just
no.
espousing, if you want people to contribute to the church, to the temple, to the mosque, how are you going to keep them broke and think they're going to have anything to contribute to the community?
Yeah, yeah. Hey, sheep, I just took your wool off you. I'm gonna take that leg. I'm gonna take that leg right there and strip the meat off that. Oh, this other leg. I just got to keep cutting you off, cutting off of you, and I ain't putting nothing back.
Mm.
At some point, you have nothing.
Yeah.
And he
Bag
said,
of
"What else
bones.
can I give?" Yeah, exactly. So we have to look at it from a holistic financial way, in the way God is a God of math, and I love that. About that, you know, numbers don't lie. It's only absolute next to the truth. Is that numbers will tell you God's plan is to increase and multiply. How do we do it? Show me how do we do it. And so we use tools, and that's all in life insurance is a tool. It's an instrument. It's one of them. It's not the only way.
Right. Right.
Okay, I ain't trying to say that. It is one of the ways that you can save and accumulate, have access without taxes while having a death benefit, because one day you are going to transition, and it's in your covenant to leave an inheritance to your children and your children's children, and you don't have a plan. And when we're introducing this plan, don't be so quick to reject, because this ice from the chocolate brother is telling you, and you vanilla saying, no, you need to invest the rest and put it in the market, and they train all the chocolate brothers to say the same thing. And you have nothing secured. So you want to believe the vanilla doctor over the chocolate doctor. No, it ain't about their being vanilla and chocolate. It's about the truth. It's about the research behind and the math. And numbers don't lie when it's right. When the math is right. Hello, breaker, come on.
Yes. And it's interesting that people understand, first of all, it's legally compelled, but people understand the sound reasoning of getting vehicle insurance. You're not trying to get in an accident, but you know that it's a whole lot easier for you to have a policy that'll cover you than having to pay out of pocket if you do get in an accident, whether it's your fault or not. And as you're saying, here's the thing. You may drive for 50 years and never even have a fender bender, but we're all going to transition. Nobody gets out alive. So how much more logical to prepare if all you're doing is preparing for the day that they have to put you in the ground? But so much more if you can have an instrument, as you said, a instrument of many that can accumulate wealth, that can give you a cash benefit and a death benefit when you transition. Your family doesn't get stuck with a bill for putting you in the ground, and the generations that succeed you have something left over that they can grow and prosper. Plus, you will have given them the sound principles of understanding how to accumulate and increase, rather than to sit there just barely scraping by, as you say, broke, busted, and disgusted, and left with nothing but, let's get a GoFundMe or a Kickstarter to try to raise the funds to put grandpa into the ground, because we acted like he was going to live forever and never prepared for it.
Cornell, you just said something that made me want to release one more gem.
Please do.
Okay, I'm a PNC agency, right? I'm a life insurance agency. And there's the gem. You mentioned about car insurance, which also makes me think about homeowners insurance. There's one reason only why you buy car insurance and homeowners insurance before you buy life insurance. And again, it's static in how you've been educated. The reason why you buy it is caused by law. The banks have been pressed that their assets that you borrow against, that you get a loan for, needs to be protected with insurance.
Right.
If it were not for the law and the bank's impression that they need to protect these assets that we loan, you wouldn't have car insurance and homeowners insurance.
Nobody gets it because they want to.
But look at this paradigm here. Your life and your income is not protected because the bank, by law, it isn't required that you protect your life and your income. And if your income goes zero because you're hurt, sick, or injured, or you die, your family loses all.
Right. They lose the car, they lose the house, they lose everything.
everything, which is a perpetuated reason why many African American families go bankrupt due to when the spouse, the mother or the father dies, and
Right.
they haven't anything. They got to move back in with mom.
Right.
And that was the whole point also with the asset with the grandchild or the child. You give them a vehicle by creating this whole life policy that if they lost their job, they didn't have to go to the final alternative to move back in with you.
Right.
They could
Right.
pay their own note. But the banks, this is a gem. The banks want you to insure by law their assets so they're taken care of.
Right.
But why wouldn't you insure your income with a DI policy? Hello, hit us up. Or a life insurance policy that will be enough to pay off the house, the car, all debt, and replace the sister or the brother's income for the number of years it's required to finish raising your last child. You need that
Mm.
spousal income replacement. If you got a child 4 years old, then you
Right.
need that income replacement of your spouse for 16 years.
Yeah.
Hello, breaker. And we're
Yeah.
not doing that.
No. We're not
So
even
if
aware of the fact that these options are available, or as you're espousing, dropping science, dropping knowledge and nuggets here, that this is something we should consider a requirement.
yes, if you're going to create and when you're going to create wealth, because imagine this, remember, the whole life in any other thing is just a savings account with the death benefit. That if you got hurt, sick, and injured, you didn't have a 90-day waiting period as with the DI, or
Mm.
60-day or 30-day waiting period. You can access the capital quick and in a hurry and right away. Okay. Transition, you get that right away, tax free. So why wouldn't you save and accumulate to accommodate? Because if you never got sick, hurt, or injured, then all the money you put in the DI is just gone. Hello?
Right. Right.
If you never got in a long-term care situation, then that money's gone. But if you stuck it in a PPWL, you have access, baby, and you can pay who you want for in-home care, okay,
Right.
rather than in a nursing home.
Right. Right.
So we're saying you can't beat the PPWL. It is a solution that is a foundation to secure some wealth in while you pull wealth out to invest in the market, but you still protecting your principal. You put it back, and if you always do it, if you had an option, my question, if you had an option that I can give you a bank, a piece of property, or land, out of the three, which one would you want me to give you?
Hmm. Um. You mean you're going to give me an entire bank?
I'm gonna give you a entire bank, or you can give this land, or I can give you what was it, a property, home, or something like that. If I give you a home, I give you land, or I can give you a bank. Out of the three, which would you choose if you can only have one?
Well, if I could only have one, I never even considered these options. I think I would take the bank.
Duh, you must be my cousin. Why?
Because the
Because
bank, talk about it.
the bank has the money. The
Yeah.
bank, you got to hopefully in an up and down market get the money out of land and property, and you may not be able to get the
Right.
money out of it, and it can go down that you may get nothing. But the bank has the money.
Right.
So when you have a PPWL, which is your personal bank that you own and operate, wouldn't it be
Ah,
advisable that if there's 6 people in your family, you own 6 banks?
that makes absolute sense.
Actually, it makes dollars.
Dollars. Talk about it.
Yeah, it makes dollars because you got 6 banks that's producing guaranteed interest and dividends and revenue, and you have access anytime. And both down the road, if they told you up front, sir, I want to create this PPWL for you, and after 20 years, you will not contribute another dime. And when you get 65 and 70, it's going to give you $30,000 to $40,000 a year, tax free. It's going to pay you a check, tax free.
Yes, yes, please.
When you would exactly, you would say yes, but they never told you that. They told you to buy term.
Right, and exactly.
Come
And
on,
you know, you,
come on.
you say that you know you know it makes dollars. I have a saying, and I'm in being enlightened in this conversation. Things I've been saying for years that you've got to clock them dollars if you want to make real change.
Exactly.
And
That's
that's why,
true.
yes, you get a bank, that's where the money is. And then if you want property, you can get, it takes money to buy property, it takes money to buy land. But those things, we hope we can liquidate them to become money.
Exactly. And that liquidation is a strong factor. Well, if you got it in the 401k, you can't liquidate it because
Right.
you're going to be penalized an additional 10% above your tax bracket of 22 to 25%. You're going to give up 35%. But in the end, when you take it out, based on taxes and fees, you're giving up 40%. You remember I showed you
Yes,
46%
yes.
of your retirement money. Why put your money in and you put it all in, 98% of it or 95% of it, where you're going to give up 46% of your money? And if you're in a higher tax bracket, you're going to give up more than that. When you
Mm,
could have put it in this deal and you didn't have to give it up.
right, right,
So we're talking clocking your money. Does this not make wisdom? Everyone should have had it, and everyone should have some of it before going in the market. Now you can go in the market with a
right,
POM, peace of mind. Okay.
right,
The thing about the Roth IRA is in the market too, and you're still paying the fee, even though it's
right.
already you've already paid the taxes on. You're still paying the fees on it,
Exactly. Someone's
and
still
it's,
taking a slice of your pie. And they didn't have done, they weren't in the kitchen rolling any dough, chopping any apples.
and this is not finance. This is not investment advice. This is securing safe money to keep safe money safe. This is counsel that
Yes.
and you are still encouraged, hey, go into the market. But before you
Yes.
do, let's be out of debt.
Oh, yes. Please talk about it.
Let's get you out of debt. Why are you in the market and paying a higher rent interest rate on
Mm,
you're doubling your debt? The IOU to the Social Security to taxes is a debt.
mm,
So why be in debt and more debt and risk of losing all and have nothing saved? That's like you're investing in all these property, but you don't have one property that you own free and clear,
mm,
and you lose them all. Come on, they're
mm.
talking to Floyd Mayweather and asking what's going on.
Hmm.
I don't know. What did you
Right.
do?
Right.
Well,
How
you
could
have a
you have made hundreds of millions of dollars? And what are you talking about? You going broke? How does that even work?
how does it even work? And so something's going wrong that you know that we've not been told that basketball
Yes.
players, football players, they get
Yes.
out there, they manipulate it, they massage, they buy
Mm-hmm.
all these $1 billion home with 36 rooms. And I'm like, Ninja, you grew up in a probably a 1 to 2 bedroom home. Why are you gonna?
That's the whole apartment building you grew up in, son.
Yeah,
And you
why
ain't
did
getting no rent from any of those rooms.
what sense did it make for you to buy that? Because you've been told that someone can make a commission off of that, and so that in the end you can't keep it, and they take it all back, and you broke busted. And a number of mansions out there that no one can own. Listen, you could have been smart, like what's his name there, Akeem Elijah, not Keem, but
Shaquille
Shaq,
O'Neal.
and
Shaquille
buying
O'Neal.
business of Shaquille
Yes.
O'Neal, buying businesses that produce and make money, buying property that produce and make money. A
Yes.
home, like Grant Cardone says, is a waste of money unless it is producing money.
Right. Right.
And you
Yes.
buying a big old home and you can't live in but one room at a time, and you buying all those expensive cars and you can't drive but one
Only
at a
drive
time.
but one. Exactly. You know,
And
and
Floyd,
as go ahead.
and Floyd Mayweather said he don't even drive those cars. Ninja.
So what's the point?
What's the point? Because you want the look of success.
Exactly.
You want
Exactly.
that bling bling and the look, but not the ownership. And
Yes.
God told you to possess the land and to own it.
Yes.
Because
And talking about
the owner has the control.
yes. And talking about Shaquille O'Neal, because one of the things I love, and I didn't know this until a few years ago, but he talks about the fact that he was early in his career, he's sitting at a table with his financial advisors and a bunch of people on the other side of the table, and they're talking about what they're going to do and how they're going to invest his money, and they're talking around him as if he ain't even there.
Yeah.
And he's the engine of all of the money they're talking about is the money he's going to earn on the paint, sitting out there running up and down the basketball court. And that's
Yeah.
when he went to school, and a lot of people don't know this about him, he earned a doctorate of finance, not an honorary degree because of who he was, keys to the city kind of nonsense. Because he's like, wait a minute, this is my money they talking about. I am never going to sit at another table and you talk about me like I'm not even here and none of y'all are making this money. That's my
Yeah.
money. And he has invested, as you said, he has invested so many income generating properties, he doesn't even touch his NBA. And he made a lot of money in the
And
NBA.
that's the Warren Buffett thing, never lose money. Create
Exactly.
IPAs, income producing
Producing
assets,
assets.
income producing properties, income producing business. Create those things that reproduces after its kind. That's a biblical principle. Every
Yes.
seed produces after its kind. And so you don't have things that produce after in kind, and after you're no longer able to produce, and you have nothing that produces for you, you're broke,
Yeah.
busted, and disgusted. And so the mindset, the poverty mindset, has been passed on from you into your children because they're doing exactly what you're doing. And 9 out of 10 children are just about getting a degree, getting a diploma, getting a degree to get
Yes.
a job. And when the job goes away and when the companies lay off, and during 2008, they laid off more African Americans than any other people.
Oh, yeah. First to
Their,
go.
their unemployment was at 15 to 20% when white Americans were down to like 10%. And when it went down to 4% for white Americans, still at 10 to 12% for black Americans because we don't own the companies. We're in
Right.
a capitalist country, and all we've been taught to is to get a job rather than to
Yes.
create the job. The
Yes.
best and the brightest universities, HBCUs, are still training and educating after the degree to get a job.
Yes.
What's
And then,
wrong with that?
and to your point, what is the essential thing you need to be a successful capitalist?
You need
Cap-
knowledge.
capital.
Capitalism, yeah.
Right. Right.
You need both the wisdom
Yes, and
and
the
the
knowledge.
capitalism.
Right.
So,
Exactly. Because you can have
so,
the capital. Amen. If you don't know what to
so,
do with it, you're just going to lose it.
yeah, a fool will quickly depart from his capital.
Yes.
And
Yes.
in which we've seen that in our athletic people, they quickly
Oh,
depart from
yeah.
because
Fool and his
uh,
money will soon part ways. Yes, indeed. And there's
and
so
then
many. Go ahead, brother.
and so because they're only getting counsel from those, they're taking refuge and learn to take refuge in only those that are just have owned that market, like the insurance people who've owned the insurance market. And I say this humbly, vanilla people who came through our communities. Bless God for those that did us good and did us right. But they're the ones on the message of how to invest and what to do with these insurance. They own the authority. And it's like when you see a doctor, you
Mm,
say a doctor, the first thing comes to mind is a vanilla man in a white jacket.
right.
Why not a brother come to mind? Because that's what training and teaching have taught you via TV and everything. And
Right.
such
There's
as it is in the
representation.
finance, and yeah, in representation, such as it is in insurance. So here I am, a brother that's built my agency and been in business for myself for 20 years, self-employed, and employed my family. And I own my property of 1.3 million on an acre of land here in Lakeland, Florida, on the major thoroughfare. When I go to other counties and cities, I don't see agents. I see State Farms,
Mm,
all states and all these other brand names, which Ameriprise and stuff like that.
right.
I don't see one like mine own that's saying that's an independent owned, black owned agency.
Right.
Well, here am I. Why? Because I had to grind through faith to get here to learn the different things of how they got there and what they're saying. But the support that I aspire to have is increasing by the stick to itiveness that God has taught us, being found faithful in the least things, you'll be rulers of much, that it is growing and compounding. But how great a growth it would be if even a greater percentage of those who actually look like me just came and willingly patronized me and looked, hey, I'm not going to sell you a thing, whether you black, white, blue, or green. I love all people. Okay, I've got no difference. But I would love to see our people do better. I want to see them do these things that we're revealing, these gems here that
Right.
the vanilla has told and held secret and put in books, like becoming your own banker,
Yes.
money, wealth, and life insurance,
Yes.
um, wealth unbroken, what would the Rockefellers do, that all tell you
Mm,
are written by vanilla people that say, here's what we do that we're not telling you. We're telling you to do term and invest the rest. But what we have done and what we're doing is that PPWL, and we hid it in these books. And they
yeah.
said, it has been said, Cornell, the
Hmm.
best way to keep a
Yes.
secret from a brother is to do what?
Hide it in a book.
And they
I
got,
wish that was a joke.
I wish it was, I wish it were a joke too. And here are the books we're reading. And so here we are, coming lately, brother come lately saying, look, we read the books and we've understood, we got the understanding, and we want to show you, we're asking you to hit us up at Insure Financial Group.
Yes.
And we're going to help you get locked in where you can increase and multiply, because those those corporate owned life insurance that are PPWLs, those BOLIs, those bank owned life insurance policies that are PPWLs, they didn't show you that. And we're telling you, you're in business and you don't have one, and that you can give yourself a tax deduction off of money that you're accumulating and
Come
you
on.
have access to. Come on.
Yes, yes.
Call a 162 plan, but also call a key person or a
Right, right.
executive bonus. You don't know
Yes.
about it, and you're in business for yourself,
Wow.
and you're trying to do those Roth hours and stuff. Do yourself a BOLI and do yourself a 162. Do yourself executive bonus and get a tax deduction for money you have access to without
Yes,
a penalty.
indeed.
Hello,
Yes,
breaker,
indeed.
breaker, and a death benefit
Yes. Well, one of
that
the
you
things
can
that you're,
live.
yes.
Go ahead. I'm sorry, I got a
No,
little.
no, please, please.
You pushed the button somehow. I don't know how I let you do it. You
Well,
pushed the button.
that's why we're here having a second conversation, brother. And it seems like at a later date we're probably going to have to do a part 3. I mean, one of the things that, in summary, that you're summing up the difference between. There's a lot of black people. There's a lot of people in all cultures that are rich, but you're distinguishing the difference between rich people and wealthy people. There's a lot of rich people, but what they really are is they're broke people with a lot of money. Because wealth is a mindset, it's not a situation, you know. And the purpose of money, to me, my reckoning at least, the purpose of money is to make more money. And the purpose of making more money is not to acquire and accumulate, to flex and flash and fling and bling, but it says you can control your life and your destiny and shape your own future and your heritage and tell the story of your own history, to tell your own narrative. And too many of people, especially in our community, they look at money to the fancy Rolex watch, the car, the rims and Tims and the Henny and the Fendi and the Gucci and all, and that's not only not putting any money back in our community, that's not putting any money into their own lives and futures. As Warren Buffett says, you quote him quite often, and duly so, he says too many people buy the liability and lease the asset rather than the other way around. And what you have been going into in these past couple of hours is how to flip that script and do it the right way. You know, buy the asset. And then if you want to get the liability, or as you said, and again, enlightenment to me, buy the car cash. Now that car is not a liability. Why is it a liability? Because you are paying a loan, you're leasing it, and so it depreciates. You buy it cash, you get it at a discount. So first of all, wow, you don't even pay the full sticker price. And now that's an asset that you can now leverage. So all of this amazing stuff.
Right. So at the end of the day, so I can start with my children creating entrepreneurs from the beginning, from their birth, giving them when they reach maturity of adulthood. I can, within 5 years, have created them, transferred them into a millionaire status. And so we can be the farmers of millionaires. And remember, we said this last time, that the Black Wall Street was millionaire, was 100
yes, a city of millionaires in the early teens and 20s of the 1900s.
And they were millionaires years before they burned them down, and that was the threat.
Yes. That
we have to stop them. They're getting too much massive power. They're owning assets and creating revenue. They're not dependent upon us.
Exactly.
And if they're not dependent upon us, they can't be controlled. But we're still on a paradigm with some of the baby boomers, like what's his name, Al Sharpton's and Jesse Jackson, that's still on a March Street mentality. And I'm like, nigga, that system ain't ever worked well enough to transfer and train. It's power. Money answers all things according to the creator. Money answers all things according to the creator. Money. So we must control and create it from the seed.
Yes.
And the seed will increase and multiply and then never be broke. That's the blessing of Abraham, where increase and multiplication happens and never ceases. But if you're not starting to set up these PPWLs on your child at birth, you're doing it at the back end when your health is broke, busted, and disgusted, and it's too late to accumulate. You missed the window. The timeline trap. You fell into it, lock, stock, and
Right.
barrel.
Right. So true, so true. And Glenn, I have your information up here on the screen for those who will be watching this at some point in time, the video version. But you can get in touch with Glenn at www.ensure Financial Group, all one word. That's Ensure with an E, like, old people might have to drink, to get those supplements.
Well, you
And
got the. I'm sorry, you got the financial. You left out the N in financial.
oh, okay. Thank you so
Insure
much.
financial is an N.
Yes, yes. Okay, I will correct that. And he is at Glenn at ensurefinancialgroup.com. And for those of you watching it's a typo. I will correct it because most people at this point are listening to in the audio, and I will get that correctly in the show notes, which I will have when this goes up. Glenn, I just thank you so much. I mean, we could do a whole series. It's amazing. You were just a font of wisdom, and I love your enthusiasm and what you have to share. I'm enlightened every time in our podcast conversations and the conversations we had leading up to this, and I certainly hope and believe this is not going to be our final conversation. And as I said, I've got these two younger gentlemen and lots of people in my life that I'm going to send links to this podcast and give them your contact information. So don't be surprised when you have some folks reaching out to you because they really need to hear what you're saying, because this is not just words, this is wisdom, as you're saying, this is planting seeds, because nobody's going to come over the hill to take care of us. It's never been anybody's responsibility, and now more than ever, it's only up to us to do for ourselves. And as you said, don't sit here standing in somebody else's field waiting for fruit to fall off the tree. Become the farmers, plow your own land, till your own fields, plant your own seeds, and reap your own harvests. And Glenn, I thank you so very much for your time. And do you have any parting words before we end this week's conversation?
Well, I want to thank you for this privileged opportunity once again, Cornell West. We're about your success, and those people who are here, give us a call anytime. Hit us up. Let's educate. We don't have to sell you a thing. We don't sell. We educate. We want to help you create perpetual wealth to you, your family, your next generation. So we're a good fit for you, or maybe we're not. But give us a holler. We appreciate the opportunity.
Thank you so much. Ladies and gentlemen, as I often say at every episode, life is not a race or a competition with anyone else. Life is a journey that we travel with others, but on our own. And the only person that you have to compare yourself with is who you were yesterday. And remember that the victory is not to those who are the first out of the gate. The victory is to those who persist until the end. And remember, as I always say, never quit, keep running. And until next week, my name is Cornell Green, and I am the Failure Guy. See you next conversation.